Hi, welcome to Finance 302, the Principles of Financial Management. Here's the beginning of Chapter 1, an overview of financial management. Here are some of the things that we're going to discuss in Chapter 1. Forms of business organization, how to create value for investors, stockholders and managers incur conflicts between each other, as do stockholder and debt holders. And finally, we'll wrap up with balancing the interests of shareholders and society. Let's get started by discussing what is finance. Finance addresses how financial resources are obtained, allocated, and managed by a person, a business, or a government. This class, however, will focus on the financial decisions made within the context of a business, and how that business is organized is going to affect the financial decisions made within that firm. So we will review the forms of business organizations. The sole proprietorship, the partnership, and the corporation are all basic forms of business organization. Proprietorships and partnerships. A sole proprietorship is an unincorporated business owned by one individual. There are certain advantages and disadvantages associated with this form of business organization. One of the advantages is that it is very easy to form a sole proprietorship. It is also very cheap to do so. If you have a Social Security number, you can open a bank account in the business's name as well as purchase a business license. Proprietorships are subject to very few regulations, and the business pays no income taxes. So any income of the sole proprietorship is funneled to its owner, and then the owner pays taxes on that income. The business pays no income taxes. Another advantage of the sole proprietorship is that it's easy to manage because you have only one owner, and that owner is responsible for making all of the important decisions within that firm. Some of the disadvantages include the fact that sole proprietorships have great difficulty in raising outside capital. The ability to raise capital is subject to the ability of the sole proprietor to raise capital. Sole proprietorships also have unlimited liability. That means that the personal assets of the owner can be seized to satisfy the business's debts. And sole proprietorships also have a limited life. That means that the sole proprietorship's life is limited to its owner's life. Partnerships are very similar to sole proprietorships. These are unincorporated businesses owned by two or more persons. The advantages and disadvantages are very similar. So for partnerships, it is very easy to form a partnership. It's subject to few regulations, and the partnership, the business, pays no income taxes. Income of the partnership is funneled to the owners, to the partners, usually on a pro rata basis, and then the partners pay taxes on that income. Some of the disadvantages of a partnership is that, yes, it is difficult to raise outside capital. It has unlimited liability. The partners are responsible for the business's debts, and the partnership has limited life, limited to the life of the partners. There are a couple of additional disadvantages associated with the partnership not listed here. For partnerships, it's hard to transfer ownership to anyone who's interested in being a part of that business. So it's hard to transfer ownership. Furthermore, it's hard to get everyone to agree. Once you put more than one human being together, there is going to be some conflict. They're not always going to agree when it's time to make certain decisions regarding that business. The corporation. Well, our class and our textbook is written from the standpoint of the corporation. What is a corporation? It is a legal entity that's created by a state to conduct business that is separate and distinct from its owners. So, of course, there's going to be some advantages and disadvantages associated with this form of business organization. The corporation has an unlimited life. It can go on forever. It is not tied to the life of its owners. It is very easy to transfer ownership in a corporation to someone else because all corporations, ownership is evidenced in all corporations by common stock. Another advantage is that there is a limited liability associated with the corporation. Someone who owns stock in a corporation will never lose more than the amount that they've invested. So, in other words, personal assets can't be seized to satisfy the business's debt with a corporation. Corporations also have an ease with which they can raise outside capital. Why is that so? Because their stockholders have that limited liability. Some disadvantages with an organization set up as a corporation is that income from that corporation is subject to double taxation. Since the corporation is an entity unto itself, it is separate and distinct from its owners. The corporation must pay taxes on its income. When that income is then distributed to owners in the form of dividends, then the owners, the stockholders, must pay taxes on that income as well. So it's taxed at two levels. Same income, taxed twice. Another disadvantage is that there is a hefty cost associated with organizing a firm as a corporation. Furthermore, there are many reports that need to be filed and many regulations that corporations have to follow. We do have some hybrid forms of business organizations, and they combine the best of both worlds in that all of these hybrid forms offer limited liability, which is a big plus, and income is taxed only once, and that's at the ownership level, not at the business level. So we have subchapter S, corporations, which is mainly attractive to small businesses. We have the limited liability partnership and the limited liability corporation.